You have a dozen indicators on your screen, a chaotic mess of lines and colors that promise clarity but deliver only confusion. You've read 3 different books on trading, each one contradicting the last. You follow 5 different market commentators, and when the moment comes to act, to place your capital at risk, you freeze. The signals are a tangled knot. One tells you to buy, another screams to sell. This is the paralysis of analysis, the state of being information rich but wisdom poor. It is the single greatest obstacle that separates the hopeful amateur from the consistent professional. You're trying to listen to a symphony by focusing on a single violin, a single drum, a single flute, all at once. The result is not music, it is noise. A true strategy is not about adding more tools. It is about synthesis. It is about understanding how the few core principles of the market work together in harmony to tell a coherent story. The market is not a random number generator. It is a story of human emotion, driven by the twin forces of greed and fear, and it is written in the language of price and volume. A professional trader is not a fortune teller. They are an expert storyteller, one who has learned to read the narrative as it unfolds. Strategy synthesis is the process of weaving together the essential threads of this story. The overall market structure, the specific location of price, and the precise confirmation that signals a change in behavior. Without all 3, you are simply guessing. You are acting on a single piece of evidence without understanding the context of the entire case. This is why so many trades that look perfect in isolation result in a swift and painful loss. The indicator was right, but the location was wrong. The location was right, but the market's overall direction was against you. You had 2 pieces of the puzzle, but the third, most critical piece was missing. Let's begin by dismantling this complex machine into its 3 core components. The first is market structure. Before you even consider a trade, you must answer one question. What is the dominant trend on the higher time frame? Imagine you are a general planning a campaign. You would never deploy your troops without first studying the terrain, understanding the major rivers, mountains, and strategic positions. The higher time frame chart is your strategic map. It tells you whether the path of least resistance is up, down, or sideways. If the market is in a clear uptrend, with a series of higher highs and higher lows, your primary focus should be on finding opportunities to buy. Attempting to short sell in a powerful uptrend is like trying to swim against a strong river current. You might make a little progress, but the energy expended is enormous and the risk of being swept away is constant. Conversely, in a downtrend, the path of least resistance is down. Your focus should be on finding opportunities to sell short. Fighting a downtrend is like trying to climb up a landslide. The ground beneath you is constantly giving way. The third state is the trading range, or consolidation. This is where the market is in balance. The buyers and sellers are in a temporary truce, and the price moves sideways between 2 well-defined boundaries. This is not a time for trend following. This is a time for patience. A trading range is a cause being built. It is like a spring being coiled. Energy is being accumulated for the next major move, either up or down. The professional trader understands that inside this range, the odds are not in their favor. The real opportunity comes not from playing the small bounces within the range, but from correctly anticipating the direction of the breakout from that range. So the first step in any coherent strategy is to step back. Look at the weekly or daily chart. Identify the primary current. Are you in a river flowing north, a river flowing south, or a calm lake where the water is still? Your entire tactical plan will be built upon this single foundational observation. Once you have identified the market structure, the second component is location. This is your tactical zone of engagement. If the market is in an uptrend, not every price is a good price to buy. The amateur buys out of excitement, chasing the price higher after a big move. They are driven by the fear of missing out. The professional, however, waits. They wait for the price to pull back to a logical area of support. What is support? It is a price level where, in the past, buying pressure was strong enough to overcome selling pressure and push the price higher. It is a historical battlefield where the buyers have already proven they are willing and able to defend their territory. Buying at a known support level in an established uptrend is a high probability action. You are entering the market at a location where the odds are stacked in your favor. You are buying where institutional demand is likely to re-emerge. Think of it like this. A store wants to sell a popular product. It can either raise the price when demand is high, which might deter some buyers, or it can wait for the price to drop to a reasonable level, a sale, where a flood of new buyers will enter. The smart money in the market operates on the same principle. They do not chase prices higher. They wait for the sale. They wait for the price to pull back to a discount, to a location where they can acquire their inventory at a favorable price before the next move up. Your job as a strategic trader is to identify these locations in advance. These are not random lines on a chart. They are zones of significant past activity. This could be a previous swing low, a major consolidation area, or a level where a high volume of transactions occurred. By waiting for the price to come to you at your chosen location, you shift the dynamic. You are no longer reacting emotionally to the market's every move. You are acting deliberately like a predator waiting for its prey to wander into a pre-selected ambush zone. The third and final component is the trigger, or the confirmation. You have identified the overall trend. You have selected a high probability location. Now you need the final piece of evidence. You need to see the market itself confirm your hypothesis. You need to see the footprints of the large operators re-entering the market. This confirmation comes in the form of specific price and volume action. It is the moment where the story crystallizes. For example, let's say the market is in an uptrend and has pulled back to a key support level. You are watching, waiting. The amateur might just place a buy order right at the support line. But the professional waits for proof. What does that proof look like? It could be a spring. Imagine the price briefly dips below that key support level. This is a deliberate move designed to trigger the stop-loss orders of the crowd who bought at support. It shakes out the weak hands. Then, almost immediately, the price reverses and closes back above the support level, often on a surge of volume. This is a powerful signal. It tells you that the apparent breakdown was false. It was a liquidity grab. The large operators absorbed the selling from the panicked crowd and are now ready to resume the uptrend. That sharp reversal and close back above the key level is your trigger. It is the market raising its hand and telling you, the test is over. The buyers are in control. Another form of confirmation could be a test on low volume. After an initial bounce from support, the price might drift back down to retest that level. If this retest happens on very low diminishing volume, it is a sign of strength. It tells you that the selling pressure has been exhausted. There are no more sellers left to push the price down. The path of least resistance is now to the upside. The absence of selling is, in itself, a powerful buying signal. The trigger is your green light. It is the final confirmation from the market that your analysis of structure and location was correct. Only then, with all three components aligned, do you commit your capital. Let's synthesize this into a complete, practical framework. Imagine a stock that has been in a clear, healthy uptrend for several months. That is our market structure. We are only interested in buying opportunities. We observe the price making a new high, and then, as is natural, it begins to pull back. We do not chase the high, and we do not panic during the pullback. We consult our strategic map. We identify a key support level, perhaps the peak of a previous consolidation range that the price broke out from. This becomes our location. This is our zone of interest. We now enter a state of patient observation. We are waiting for our trigger. The price comes down and touches this support level. The uninformed trader might buy immediately. The strategic trader waits. The price churns at this level for a few days. Then, one morning it opens lower, drops sharply below our support level, and for a moment it looks like the trend is broken. Panic sellers come in. The crowd that bought at support now has their protective sell orders triggered. But then, by midday, the buying pressure returns with force. The price rallies strongly and closes near the high of the day, well back above the support level. We look at the volume for that day, and it is significantly higher than average. This is our confirmation. This is the spring. We have our structure, uptrend, our location, key support, and our trigger, the false breakdown and strong recovery on high volume. Now and only now do we have a complete high probability setup. The next step is execution. Where do you enter? A conservative entry would be to wait for the price to move slightly above the high of that spring day. This confirms the immediate upward momentum. Where is your stop loss? This is the most crucial part of risk management. Your stop loss is the point at which your entire trade hypothesis is proven wrong. In this case, a logical place for the protective stop order would be just below the low of the spring. If the price goes back down and breaks that low, it means the buyers who showed up so forcefully have failed. The analysis was incorrect, and the trend may indeed be changing. The stop loss is not your enemy. It is your insurance policy. It is the predefined price you pay for being wrong, and it ensures that a single incorrect trade can never cause a catastrophic drop in your account balance. It preserves your capital so that you can trade another day. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding this framework, structure, location, trigger, also protects you from the most common psychological traps. The first is the fear of missing out, or FOMO. When you see a stock soaring, the emotional impulse is to jump in before you miss all the gains. A synthesized strategy prevents this. You ask yourself, what is the structure? It's an uptrend. What is the location? It's extended far away from any logical support. There is no high probability entry here, you simply let it go. There will always be another opportunity. A professional trader is defined not by the trades they take, but by the poor trades they patiently refuse to take. They understand that capital preservation is more important than chasing every potential gain. The second trap is trying to catch a falling knife. A stock is in a steep downtrend, losing value day after day. The amateur sees this and thinks it's so cheap, it has to bounce soon. They buy, and the price continues to fall, leading to significant financial loss. The strategic trader applies the framework. What is the structure? It's a clear downtrend. The path of least resistance is down. Therefore, buying is a low probability action. They will not even consider a long position until they see evidence of a change of character, a prolonged period of accumulation, and a clear sign of strength that indicates the downtrend is ending and a new uptrend may be beginning. The strategy acts as a filter, removing low probability, emotionally driven decisions from your process. Let's consider the opposite scenario to build a more robust mental model. Imagine the market structure is a clear downtrend. Our goal is to find a high probability location to sell short. We identify a key resistance level, a former support level that has now been broken. Price tends to retest broken support from below before continuing its downward path. This broken support, now acting as resistance, is our chosen location. We wait for the price to rally up to this level. The amateur who is trapped in a losing long position might see this rally as a sign of hope, a chance for the stock to recover. The strategic trader sees it as an opportunity. The price reaches our resistance level. We wait for confirmation of weakness. What could that be? Perhaps an upthrust. An upthrust is the mirror image of a spring. The price briefly pokes above the resistance level, attracting buyers who believe a breakout is happening. It triggers the stop orders of those who were already short. Then the sellers overwhelm the buyers and the price collapses, closing back below the resistance level on high volume. This is a sign of distribution. The large operators use the rally and the excitement of the breakout chasers to sell their positions at a favorable price. This upthrust is our trigger. We have the structure, downtrend, the location, key resistance, and the trigger, the failed breakout on high volume. We can now initiate a short position with a protective stop loss placed just above the high of the upthrust. If that high is broken, our thesis is wrong, and we exit with a small managed loss. Now let's address the inevitable question. What happens when it doesn't work? You follow the process perfectly. You identify a clear uptrend. You wait for a pullback to a perfect support level. You see a textbook spring confirmation. You enter the trade with a clearly defined stop loss. And then the market reverses, hits your stop, and you take a loss. The amateur reaction is frustration and doubt. The system is broken, the market is rigged. The professional reaction is one of indifference. They understand that no strategy is 100% accurate. Losses are a part of the business, a cost of operation, like a store owner accounting for unsold inventory. A well-synthesized strategy has risk management baked into its very core. The stop loss is not an afterthought. It is part of the initial plan. The professional knows their win rate might only be 50% or 60%, but their winning trades are, on average, significantly larger than their losing trades. This is called positive expectancy. They might lose 1 unit of risk on a failed trade, but they aim to make 2, 3, or even 4 units of risk on a successful one. Over a large series of trades, this edge ensures profitability. Therefore, when a trade fails, the professional does not question the entire strategy. They accept the loss, document the trade in their journal, and wait for the next high-probability setup to appear. They know that their profitability comes not from any single trade, but from the consistent application of their edge over time. It is a statistical game, not a game of perfect prediction. The beauty of strategy synthesis is its adaptability. It is not a rigid black box system. It is a logical framework that helps you interpret the market's narrative. The specific triggers might vary. Sometimes it will be a spring. Other times it might be the absorption of supply at a key level, where you see the price refuse to go down despite heavy selling pressure. Or it could be a simple sign of strength, a powerful upward bar on high volume that breaks a key resistance level, signaling the start of a new markup phase. The principles remain the same. Align your trade with the dominant trend, enter at a logical location, and wait for the market to show its hand before you commit. This method forces you to become an active thinking participant rather than a passive follower of signals. It trains you to ask the right questions. Instead of, "What is this indicator telling me?" you start asking, "What are the large operators trying to achieve here? Where is the evidence of their activity?" You begin to see the chart not as a series of random wiggles, but as a strategic battleground. The trading ranges are the periods of preparation, where armies are being amassed. The trends are the campaigns, the major advances and retreats. The springs and upthrusts are the tactical feints and skirmishes designed to mislead the opposition. By synthesizing the core elements of market action, you move from being a foot soldier reacting to the chaos of the front lines to being the general, observing the entire battlefield from a high vantage point and making decisions based on a complete strategic picture. Let's conclude by solidifying this into a mental checklist. A pre-flight routine you perform before every single trade. 1. What is the dominant structure on the weekly and daily charts? Am I aligned with the path of least resistance? 2. Have I identified a key, historically significant support or resistance level that serves as my location? Am I waiting for the price to come to my level, or am I chasing it? 3. Is there a clear, unambiguous confirmation signal? Have I seen evidence of institutional sponsorship in the form of price and volume action that validates my thesis? 4. Do I have a predefined entry point, a predefined stop loss that invalidates my idea, and a logical target for the trade? Do I know exactly how much of my account I am willing to risk on this single idea? If you cannot answer all 4 of these questions with absolute clarity, you do not have a trade. You have a gamble. You must step away from the screen and wait. The market offers a near infinite number of opportunities. Your capital, however, is finite. The purpose of a synthesized strategy is to protect that finite capital by deploying it only in those rare moments when the evidence is overwhelmingly in your favor. It is the practice of professional patience. The journey to becoming a consistently successful trader is not about finding a secret indicator or a magic formula. It is about building a robust, logical framework for decision-making. It is about understanding the timeless principles of supply and demand, of human psychology, and of risk management. It is about taking these distinct concepts and weaving them together into a single, coherent strategy that fits your personality and your time frame. The market speaks a clear language. The work is not in predicting the future, but in learning to listen to the present. If you wish to become fluent in this language, the journey of learning and observation must be a continuous one.